Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
That would make me Guy Allard. Welcome.
Welcome. We developed this show decades ago, I guess now. To answer your financial questions. What we found was, I just talked to a client of mine. It's been a client for almost 20 years. And I just forgot. He reminded me how he met me. He was going to one of my seminars. What I used to do is show people hidden fees in mutual funds.
Right.
And I was always one of those, I guess, nerds into the details. Remember, the number one rule of sales when we got in is no details. I was always a detail guy.
Sell the sizzle, not the steak, all that stuff.
I've always been a detail guy.
And they tell you not to do that, right?
Yeah. Don't read a prospectus. I've read 1,000 of them.
Yeah.
And I want to read every page. But I wasn't trying to rail on mutual funds. At the time, I sold mutual funds. I just didn't think that you should be paying ridiculous fees. You might have one mutual fund that's overlapped the same stocks, but 90% the same stocks as the index fund and charging 5 times as much.
Well, there's lots of things. Remember, year end, they get paid, so maybe they do a little adjusting for the yield so that they get a better bonus. If you get too many people wanting money, they may sell you out of something you don't want to sell out of. They're kind of forced to it. There's a lot of stuff with mutual funds.
Well, I explained the soft cost and the hard cost.
Right.
There used to be things where people were getting savvy of fees in mutual funds, so they'd send them a Bloomberg terminal or make their trades $20 when they can get them for $1.
That's right.
Going to Schwab or something. So those are the kind of things that I would explain, and that's how I got. But I'm the same way with everything. We do managed accounts now, and I'm going to break down a managed account to its very core and make sure that every single piece is in your best interest. Same thing if you're into annuities. Annuities, there's 144 just index annuities. There's probably 4 or 5 that have passed the test. And this is, just to give an example, we're the first ones in the United States to talk about this stuff on the radio. The very first. And I've still been that detailed. And that's what you need. You need an engineering brain to decipher this stuff. Because if you just remember the old times, the old sales guy, my dad was one of them. He said, you don't need all the details. Just take them to lunch, take them to golfing, blah, blah.
They're buying you. They're not buying the product. Right. They got to like you. That's right.
He always said, you're wasting your time getting all those credentials, because I was getting every one you could. Every credential you could get. And he goes, you're wasting your time. Obviously, what I told him was that people are going to be more educated. Consumers are going to be more educated. You have to have more. Knowledge is everything, and that's what we continue to do today.
I tell you what it's done, though. You can definitely tell. And when Victor says I, just so the listeners know, he means we. I just want to add that too. But what it's done, and you can definitely tell, is look at our client base. Usually, and there's nothing wrong with blue-collar workers. I love them. They're ones that it makes you really feel good because they need a hand with the 401k, and they don't spend their time going through it. But and that's usually was most of the client base. But our client base is a lot different than most other firms. Engineers, CFOs, accountants. I've got several attorneys. It's the real cerebral group of people because of the way that we go through the information. We go through the information.
We used to be taught when we got in this business in the 80s, don't talk to engineers.
Oh, yeah.
They're the worst.
Oh, yeah.
And I love them the most because they're the most loyal group of clients you could have.
Logical.
As long as you have the facts. The problem is most advisors don't. It's amazing. I'll call them out all the time. Advisors, these are big company advisors that don't even know the products they're selling. They don't know the details.
And the advantage of dealing with logical people like engineers, when you do a good job for them, they stay with you. They appreciate it. Now, the reason I bring that up is to try to get Victor to tell a story about a client that he had just recently that averaged 7.5%, and because of better, as we're talking about, salesmen came along. They liquidated everything and moved and said, oh, no, 7.5% wasn't enough, right? And you told them, well, listen, the stock market's only made 5 over the last 17 years. And they said, oh, no, 7.5 isn't enough. Isn't that basically the way it went?
What happened was somebody had to cherry pick the dates. He just didn't realize it.
Oh, to use the statistics?
Yes, to get above like 9-10%.
Right.
Like the big annuity hitter Ken Fisher, I think, has averaged 4% for like 18 years. It's not anything near this 10% that we had so long. And
That you hear
10%
about.
was kind of the rules up until the 2000s.
Right.
But the 2000s have changed things. Now remember, part of that was
Big part
half
of
half of the return on the stock market was always dividends. You got a 5% dividend, about a 5% capital growth,
it.
right?
10%.
10%. Problem is dividends are less than 2% now. And so if you got the same growth, you're only making 7. Well, we got a little less growth because a lot more volatility in the 2000s. So we got 5.27. But it's hard. Like I said, when you make 7.5 for somebody for the same period of time the market made 5 with no market risk.
With no risk in the investment.
But they did, like I said, that's why you got to be careful. Some guys are selling you something, and some guys are advising you. And you can. It's easy to kind of tell. Just ask them certain things. Should I put everything I have in this one stock program? Oh, of course you should.
Or instead of saying everything you have, because that may be a tell,
Right.
if you will. Say I've got about $450,000 in my retirement account. That's my investment portfolio. How much would be appropriate for this? Right. And then if they tell you $450,000, a red flag ought to start waving.
Well, Kiplinger had an article that I thought was pretty interesting this last month, and it was the 14 retirement worst mistakes you can make. So you'll regret forever. And I agreed with a whole bunch of these, so I thought we should go over them. We've talked about these individually at times, but it's nice to have kind of a summary of it. All right. One of them is relocating on a whim. I have personal experience in this. Some customers we're going to move down to, Galveston or whatever. Then a hurricane hits. It's like,
I've had a couple too.
Or they didn't like it.
Yeah.
Let's say they're used to living in a city with all the different benefits of a city, and they always vacationed in the country, but the day-to-day grind out there was what you only play golf so many times,
and you're not close to doctors in the country.
Right.
I love the country, grew up in the country, but it has
plus they don't know
drawbacks
anybody
too.
there.
That's right.
So the better option there would be maybe go rent a place for a year or 6 months, and actually do the living before you actually buy in and all that kind of stuff. And so that's one mistake, because some people used to have a lot of some of the northeastern people would move south, and it was just too, like South Carolina or something. It was too slow of a pace for them.
Or too hot in the
yeah,
summertime.
it's too hot. So those kind of things, make sure you
They didn't
try
like iced
renting
tea.
first. Right. If you don't like sweet tea, then you're not an American. I'm just saying.
I'm just saying.
Something wrong with you. Another thing is, by the way, let me finish that. Retiring overseas. You hear a lot of people, I'm going to go to, Central America or whatever. But, boy, they've got some rules and some laws and stuff that, really can hurt you or you're not expecting.
Even the Virgin Islands, I think St. Croix, I forget which one, and we're in Texas, obviously has a big Texan population down there.
I didn't know
But you
that.
get this deal, it's called like island fever. I hear that from people in Hawaii. You're on a rock.
St. Croix is not very big.
Yeah, you can't go very far, and it's great for vacation for a few weeks, but permanently,
I'll tell you what, I'll give you one quick story. We're in about 1985. I was in the military. We pulled into St. Croix, Virgin Islands. That's the U.S. Virgin Islands. Beautiful. I was catching fish right in the bay, and just
I
gorgeous.
thought you were going to say women.
No. And they told us, do not be out after 11. Now, we're young, 20-year-old,
Great
full
shape.
of whatever, right?
Yep.
Are you kidding me? Well, these Rastafarians, they call them, with the long dreadlocks that sell drugs to everybody.
Right.
A gang of them started coming after us at the bar.
Oh, really?
We had to run to the police station, and then the MPs came and picked us up. Yes, it was real. I was like, holy crap, because it's beautiful during the day.
They weren't trying to sell drugs. They were just trying to get in a fight or what?
They're trying to get us.
Damn.
And they told us this is what happens after so-and-so, and I'm like, okay. I'm sure it's better now, but
Yeah.
that's my one story for the show right there. All right. Another thing what people do is they fall victim to scams. Lots of scams, too good to be true offers. A lot of them say, you've won all this money. You just send us the one thing so we can pay the barrister or whatever they're going to call the lawyer over there. $2,000, we're going to get you your $100 million.
And the worst one, and that's probably, you guys can ferret that out. Most of you, it still does catch some people. The worst people, the ones that really need the money, end up falling for those. But life settlements, which was a fancy word for saying viaticals, which is basically buying life insurance people on terminally ill people, was the last one. And you can call it a scam, and it got a lot of people in retirement with money they couldn't afford to lose, and now they're in court and they got to keep making payments, but yet it's not going to the right place, and it's just a mess.
I'd say during the radio, we've been on the radio a long time. 70% of the radio guys were touting these life settlements. 70%, we'd always said they're no good, don't do it. Anytime you have a private investment, they can screw your eyes out and not even blink twice.
When we started doing this, I did a show on a different radio station other than KRLD. I won't mention it because of any liability, but it ended up being a den of thieves. There were so many people on that station that were touting things that absolutely weren't registered, no compliance, no accountability, life settlements type of stuff. I had to get off that station because I didn't want to be included with that group.
Well, what you have to do is, let's say it's an easy way to tell if you're in a private anything that a felon can get out of prison after 30 years
and sell
and then become the number one salesman for life settlements, private real estate investments.
Yeah.
That's something you shouldn't be in.
Probably not,
because there's no rules. It's like the Old West. And trust me, it's not going to work out in your favor. I think the one thing now that people aren't getting is about 2-3 years ago they allowed private investments to advertise. Now they're with 20% real estate units on secured money. 20%. I go, they might have 100% profit when they purchased it, and they're going to charge you 10% a year to manage it, and they can change that to 40% a year after a year. There's no laws, no limits. It's all free for all.
And when they say it's secured, we know what they're implying. They're implying that your money is secured, but your $100,000 investment may be secured with a $10,000 purchase, so your money isn't secured. And I'll take it a step further. I won't mention the name, but he is a biggie out there. You have to watch what they say. They talk about their fees and not paying commission, and you see the commercial where the poor client that's with the guy that made a commission on his money is looking guilty, and he walks over to the other side where they make a fee, and then they end up by saying, "We do better when you do better." Well, makes you think that they don't make money when you lose money, and that's not the case. They make plenty of money when you lose money. Of course they do better when you do better because you've got more money now for them to make their fee on. But that's not the sound of it, and I quite frankly think that commercial should be looked at.
Well, think about it.
We do better when you do better.
Days, they don't even make this much up front anymore. But let's say, like on the mutual funds, the old days you made 5%.
And then wrap them?
Okay. Yeah, well, not be talking about that. Compare 5% load, which I don't ever recommend loaded funds, but think 5% load, or the guy that's saying I'm doing the right thing at 1% a year. Well, over 10 years, even if the money doesn't grow, you pay 10% of that one, right?
1% every year for 10 years.
But what if the money grows? So let's say it makes 7% a year, doubles in 10 years. You end up paying 15, 16, 17% when the loaded one was 5.
Yeah.
And they don't even have 5% loads anymore. So you got to really dig down.
And then remember the old days, A, B, and C funds, that you had the ones with the loads up front, and you'd do those if it was an account that was trading a lot because you didn't have to worry about it.
That's right.
And then the ones where you paid transactional fees were the ones where you just buy and hold, right? Because you didn't want to have the fees accumulating. So there was a way to kind of navigate.
Stay away from C-share mutual funds, folks. That was the brokerage industry's answer to the registered investment advisor industry. And all they did was strapped another 1% on an already high fee.
Yeah.
It was already a ridiculous fee, and they took another 1% on it. So those are the kind of things that make brokerage companies rich.
And if I can do a self-plug here, if all of that's confusing to you because you don't do this every day, we do. Call us. There's no obligation. We're happy to take a look at the fees and see what's going on and give you an answer. The number is
972-715-2424. Again, 972-715-2424. 2424, or you always go to our website, ilovemyretirement.com. Remember, anything these scams, anything that's saying a huge return and minimal risk, all those kind of things, those are telltale signs that you've got an issue there. Don't believe whatever they say. I hear this all the time. We got an A rating with the Better Business Bureau.
That
doesn't mean anything, but folks, you remember the Better Business Bureau, and nobody's complained lately, you're okay. It used to mean something back in the day, remember?
Because people would use it. If they were unhappy, they'd call the Better Business Bureau.
Doesn't mean anything. You pay the fee and nobody's called today, you're fine.
Yep.
All right, what's another one? Here's one that I could see a lot. We're talking about the worst retirement mistakes. Planning to work indefinitely. This is my choice, probably, guys.
Yeah, what's wrong with that?
All right. There's no. Now, let me tell you, 53% of all workers plan to work past 65. Here's the issue. Only 1 in 5 actually keeps a job.
Only 1 in 5 can?
That's right. What happens is, when they go to the layoffs, are they going to get rid of the high-salaried old guy with the high, or the low-salaried young guy? Now, they get rid of the high-salaried young guy. So, or health reasons.
And I'll give you, if I can, a real quick example. Good friend of ours, an attorney for a large firm here in town, had to train 2, we'll call them young whippersnappers. He was our age, middle age, let's call that. And trained a couple young 30-year-olds, and just as soon as they were trained, they let him go. They put him on a...
You train your replacement, that's what I tell him.
And they put 2 of them for the same price, probably less than his salary, and then they put him back on as a contractor. Yeah. So no 401k, no insurance, and that only lasts a year or so for the transition for continuity, and then that's gone. So we see this happen.
You got layoffs, you got downsizing, you got buyouts. That's more happening now in a good economy, buyouts. Trust me, if your company got bought out with another company and they've told you they're going to keep you, you got about a 2% shot, because they know their people, and they're going to put them in and start saving money. Let's save money. We got dual jobs here. Take out that one. They don't take out the people they've known for 20 years. They take out these newbies they don't know anything about. And you might have been there 30 years. Let's get rid of those high-paid guys. We already got guys who are high-paid. We're doubling up here. Let's get rid of them. So you got to be real careful. And another thing is, all these people that plan to retire, only 1 out of 5 actually can do it. But only 28% of people that plan to retire have a backup plan in case they can't still work. That's scary.
Meaning money saved?
Money saved, or enough money saved. How about that?
How about that?
Right. So that's an issue. So remember, even I've got people right now doing a retirement plan, doesn't plan to retire. They're 70 years old, don't plan to retire. And I'm still going to do a plan based on 75. And I gave them the logic. I'll go, what if you physically can or whatever? At least you know you can
65.
retire. No, they're 70 now, and I'm going to do a 75 retirement date.
At their age of 75?
Yes.
Okay.
They already say they're not going to retire, but they said, now that makes sense. It makes sense to have a backup plan.
One thing I'd say for sure, our clients, through our planning, whatever age you're going to retire, let's call it 70, you will know what your income will be at 65, at 67. The plan details it each and every single year. So
all of the taxes involved, it comes to the taxes to the penny.
Yep. And again, we use, not to be cutesy, but we use the guaranteed version so that you'll have hard and fast numbers.
And also, remember, our written retirement plan, everybody, you should have one. If you do not have one now, your advisor should have given you one. If not, we offer this service free of charge and no obligation. And this thing takes us hours. It's well worth a couple $1,000s. But we do that for every one of our listeners. If you don't have a written retirement plan, you need one. I don't care if you're 40 years old. You need one.
And the good news is, once we put that time in and have it, it's easy to make adjustments on the fly as you go.
I just had one the other day. They said, we had our expenses at this, but we really thought about it in between our meetings here. Can we bump that another $1,000, $1,500? I said, we'll do it right now. See what happens.
Yep.
And if it happens where it becomes an issue now, well, we make adjustments to it. But going in, you can make small adjustments now or huge adjustments at retirement. Okay? All right. One of the biggest retirement mistakes, again, putting off saving for retirement.
Well, I got kids in college. It's hard.
The average retirement balance is under $25,000 in America, by the way. People really don't save. Now, don't get me wrong. Not everybody. There's a small minority that are really good savers. My engineers always. I've never seen an engineer that didn't max out a 401k. I don't think I've ever seen one.
Oh, and they start early, too.
Oh, yeah, that's right.
They start early.
But most people don't start saving until their 40s or 50s. The bad news is it's going to take more. Remember, we've talked about how much does it really take? Well, there's 2 numbers you can use. Your annual expenses, whatever you're spending a month, multiply by 12, multiply by 25, and multiply by 35. You're going to need somewhere between those 2 numbers, depending on interest rates, when you retire. Now, so if you're spending $100,000 a year, that's $2.5 million to $3.5 million. And trust me, those numbers are not arguable. If a broker tells you, no, I can get you $100,000 on $1 million, run for the hills. Don't leave their office. Run, because they're giving you their opinion, which is not based on reality. If the market made 5% they're saying 10% with no down years.
And let me take an even closer look at that underneath the microscope. If they can average 10% a year growth for you, right? Very difficult to do. Very few people on this planet have done
Plus you're
that.
being more safe as you get retired.
Right.
You got half of the money saved.
So let's say they can get you a 10% average. Well, to get you a 10% average, again, if they can do it, you've got to be in a risky stock or
Real
mutual
risky.
funds or ETF, exchange traded fund or something. If you're in a risky one that's going to average 10%, it's going to have a deviation. It's going to be up 30% one year. It's going to be down 30% the next. So if they can average 10, you take those same numbers and take your $100,000 withdrawal on it. You will see the whole thing completely crumbles.
It collapses.
Like a house of cards. You can't do it. And what's the fancy term?
Sequence of returns risk.
Sequence of returns risk, meaning if it goes up and you're taking out and it goes down and you're taking out, you're not getting anywhere near that 10% average.
Well, think about this. If the market went down 50% like it has twice in the last 18 years, twice, and you've taken out 10%, your $1 million is now worth $400,000.
Right.
I don't care what you make going forward, you will never recover. It's impossible.
That's right.
So don't listen to numbers. Never lie. People will mislead or just show you the highlights without showing you the lowlights, right? But numbers never lie. If there's a possibility you could get down to 40% of your savings you spent your entire life, you cannot do it. Don't do it.
And the problem with this is one of two things. Either they know, which they should, and they're not explaining that to you, or they don't know, which I think may be worse.
Well, that's what I told you. I said they're either ignorant or they're trying to scam you.
And ignorance not necessarily bad. It means you just don't know.
I've tried to go, no, everybody knows this. I'm like, you kidding, right?
Yeah.
You have no idea what you're talking about. One guy, it was an annuity argument.
Yeah.
He goes, there's never use for annuity. It was a Bank of America guy. And I said, all right, what if a client saved only $1 million? I know he should have saved more, but he needs $80,000 a year from his retirement savings. What are you going to do? I'm going to tell him to lower his lifestyle. I'm going to tell him to get realistic. I'm like, kid, he's got this lifestyle now. You're going to tell him what? Go live in a trailer from where his house is? Change it? Work another 10 years? What if you can't work another 10 years? I go, that's a simple question you ask, and that will eliminate anybody that's talking logically. If you need $80,000 a year, there's only one thing that will produce it.
Yep.
And that's an annuity.
But I will add this. The only reason he said is I would tell him to lower his lifestyle and blah, blah, blah is because you were on the phone. If you weren't there and the client asked him, he would start showing him things that average 10 or 12% is what he would try to do.
All right. Here's another mistake, retiree or big retirement mistakes. Claiming Social Security too early. This is the hardest one as an advisor to ever. They go, it's not going to be there.
But it's going to run out in a few years.
It's going to run out. It's not going to be there. A bird in the hand, I'd rather take this now. I know it's supposed to be up 30% if it's going to be there, but we know it's not.
Right.
It's my money. I put it in there. Well, let's be honest. With Social Security, you did put money in there, but it's not anywhere close
to what
they're going to pay you.
That's right.
It's not. I heard that argument the other day. I go, you max it out for what, 40 years? You put about $300,000 in there. And he goes, no way. I go, add it up. They used to only charge us 6% on $40,000. Then it was 50. Then they got right now it's 100 something. Add all that together, I've maxed it out for 30 years in a row. And I'm telling you, I think I've got $300,000 in there, something I put in there, and they're going to pay me $4,000 a month.
Yeah.
So
for as long as you live.
No, and if I die, my wife gets it.
That's right.
I'm telling you, it's a good deal, but there's one thing. Congress will always fix it. People that are still working might have to work till they're 75. But people that are retired, you're going to have Social Security. Now, they may mess with cost of living adjustments. It's going to reduce them. They already did that a couple of years ago by eliminating energy, right? So, but think about it also. If you're married, this is money for both of you. In other words, one of you passes away, the small Social Security goes away. What do you want, the $2,000 Social Security to go away or the $4,000? So especially if you're going to work, I see this all the time. If you're going to work, don't take Social Security yet. Now, it makes no sense to take it past 70.
And I've also heard to add dovetail into that, they say the best retirement asset you have is your job.
Mm-hmm. So don't take Social Security early. At least go to full retirement age. Because that way, if you go to full retirement age, you can still work a job and they don't take away some of their Social Security.
That's right.
So remember, if you're going to work at 66, take it at 62.
They're going to take.
You can't make more than $20,000 a year or something.
Or you start losing 1 for 2 or 1 for 3, depending on what age you are.
That's right. So, and we've got a Social Security analyzer that also shows you the good, the bad, and the ugly. Just look at the numbers. Remember, being an engineering background myself, it's all numbers.
Effective and efficient.
Right. We can, like I said, we offer that at no cost or obligation. Our number 972-715-2424, or you can always go to our website, ilovemyretirement.com. What's the next one? The next retirement mistake.
I give up.
Here's one that everybody does, but everybody probably shouldn't. Borrowing from your 401k. The theory is there, hey, that's money's just sitting there. Yeah, I got to pay interest, but it's interest to myself, right?
That's right.
Sounds good, right? The problem is if you take a borrow from the 401k, they will limit you on your contributions for the next several months. So you'll miss out on those contributions on a 401k. It depends on the 401k, but a lot of them will say, all right, you took a loan out, you can't contribute for the next 6 months, 3 months. And that will affect you down the line. Also, you're using after-tax money to pay this interest, and then you'll have to pay tax again on that money when you take it out.
That's a double negative.
So those kind of things, remember, saving is kind of a balancing act. You know, you want to get as much tax deferred as you can, but when you're having to pay interest that is after tax, now you got to pay tax on it again. That's the only double taxation I know.
I don't know, Victor. I may disagree with you on that. I've heard this commercial many times. Bank on Yourself says that they can return better than an IRA. Are they wrong?
They're crooks.
Oh, there
remember the one thing. IRAs don't return anything.
That's right.
It's just a holding vehicle.
It's a vehicle.
And that's one of your number one things. How do you spot a crook? If they ever tell you we can beat the pants off your 401k and IRA, they're not. 401ks, IRAs are just holding vehicles. It's the investments inside them which can be unlimited.
That's how your account is titled.
Right. So borrowing from your 401k, don't get me wrong, an emergency, you have an emergency. But if you do not have an emergency, it is not worth it. That $50,000 you borrow now, from the interest and the lack of compound growth that you have on that money, could cost you $150,000, $200,000 down the line. Just remember that. All right, what's the next one? Oh, this is kind of decluttering to the extreme. This is what my wife wants to do because I'm kind of a pack rat. When you grow up poor, you know, Costco loves me. I'm like a premier member. I spend $2 or $3 grand a month at Costco.
Nice.
I've never ran out of toilet paper in 40 years. Paper towels out the gazoo.
It's funny.
I've got all these bleach wipes. Oh, I got like 5 cases of them things. My wife goes, what is this thing? I bought a whole new shelf just to have extra tools because I'm afraid the apocalypse is coming.
I love having backup. My wife and I have everything backed up.
I just looked yesterday when I was in the garage, and I only had 4 rolls of paper towels. Like, oh my God, it's emergency. Code red, code red. We need to go get at least 2 of them big packs from Costco. All right, so decluttering to the extreme, they're talking about, I'm going to get rid of everything, to, you know, sell the house, whatever. Sometimes you'll throw stuff away you shouldn't have thrown away. Like, remember, you got to keep tax returns for a certain period of time.
7 years, I believe.
There's a lot of things like brokerage statements. People throw them away, but they don't realize their tax basis for their brokerage account was in that paperwork. And now they're going to pay a huge tax bill when they could have taken that tax bill off the table with a basis, a proof of basis.
That's right.
So be real careful when you're just, stripping everything out. You don't have to be a hoarder like me. I think I have every tax return since 1983.
But again, just to kind of tie everything up, if you have a plan, and we're happy to work with you, again, no obligation, so that you could, and there's nothing better than visibility. Having answers. Knowledge is empowering, and we can show you exactly what type of income you have, put in your numbers, and make it custom for you.
Last thing I'll go over, we're going to miss a couple, is big mistakes in retirement. Putting your kids first. Doing a big giant wedding. Paying for their college. All that stuff with your retirement savings. Remember, you can get loans. You can get grants. You can get scholarships. You can't get any of those for your retirement. So if you blow it all on the kids, you got nothing for yourself.
Can't borrow the money.
At one point, you got to think about yourself. Well, that's our show, folks. I want to thank everybody for listening today. Don't hesitate to call us if you have any financial questions or like to take advantage of any of our no-cost, no-obligation services. 972-715-2424. Again, 972-715-2424. Or you can always go to ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.